Elise, it's great to have you here with us today. This is being recorded on a very cold, dark, slightly wet day in the run up to Christmas, although it's probably going to be listened to later in January. Um, as I said, it's great to have you here. We've got a really exciting discussion ahead of us today. Can you please start by introducing yourself and your background and what's brought you to the digital asset space?
Happy to. So thanks so much for having me, Jana. I'm Elise Soucie, Global Director of Policy and Regulation for GDF. GDF is a leading members association for the blockchain and digital assets industry, and we aim to promote and underpin best practices, greater adoption of market standards for use of crypto and digital assets. And we do that through working collaboratively with both industry, policymakers, and regulators. My background is that I've worked with both the public and private sector. So prior to my current role, I was at AFME and I led on digital assets work with capital markets banks. And prior to that, I was at the Financial Conduct Authority, where I worked across both their technology, resilience, and cyber division, as well as their international division, where I worked on digital assets. So really excited to discuss this today.
And today we're talking all about stablecoins. They are a very hot topic on the UK policy agenda at the moment, given the recent publication of two major discussion papers on the topic, one from the FCA and one from the Bank of England. Can you talk us through, as a starting point, what the landscape of new forms of digital money is and how stablecoins fit into this? Because I think we've moved on quite a lot from a split just between CBDCs and stablecoins a few years ago to a far more diverse landscape today.
Yeah, so first, now, I love a bit of monetary history. So I actually wanted to just briefly go back a little bit further than digital money. So a few weeks ago, we had our broader discussion on the singleness of money. And I know that's not our focus today, but I do think it's an important concept to mention before we get a bit further into digital money and stablecoins, because as we discussed then, singleness means that monetary exchange, it's not subject to fluctuating exchange rates between different forms of money, or as the BIS said, that unambiguous unit of account that underpins all the economic transactions in society. And that's really
like a snappy sentence, the BIS.
Yes, they love a snappy sentence. And I think that's, really critical because as we talked about, it makes sure that all of those new forms of money can work together so that we still have economic efficiencies. But why did we need that in the first place? Because as you said, like digital money in this evolving landscape, it's a hot topic in the past 10 years or so since the advent of Bitcoin. But digital money isn't actually the first time that money changed forms and physical forms. And I think that's important to remember because in a legal sense, we've now for centuries separated the value of money from the substance of which it is made. And you actually even had medieval lawyers explaining the distinction between the value of coins and their declared value when they wanted to comply with the legal requirements for loan repayments back in the day from that era. And we've also now for years had dematerialized money that exists only as account records in the context of our modern payment systems. But none of that has changed the fundamentals of money circulation and singleness. And, you have retail currency that has to be trusted by the public. And then for commercial banks, that trust is determined by their credit worthiness, reputation, liquidity. But singleness is preserved across all of it. And so when we consider this evolving payment landscape where we have stablecoins, tokenized deposits, which I would broadly put under digital assets, but central bank digital currencies and cryptocurrencies, I think that changing the physical or dematerialized representation of money, it's not necessarily new. Those technological advancements in the form money takes continue to happen over time. We used to have paper pounds and now we have the no-rip polymer. E-money has been in existence for over a decade, and that's already a regulated activity. So I think to your original question on those technological developments, I would broadly categorize those digital money as digital assets, which the digital representation of value formatted into code, which can be stored digitally, may or may not reflect ownership rights, which we can get into a little bit later, of the underlying or linked asset. And it may or may not be recorded on a cryptographically secured distributed ledger or similar technologies. I just don't want to box this in. But I think broadly, those forms of digital money are stable coins, tokenized commercial bank money or deposit tokens, CBDCs. All of these are different types of digital assets. But I think the key question is to look at, where and how new forms of digital money can and should be used within our existing financial services system, and then what changes and benefits they may bring to that system.
That's a great explanation of the evolution of money and the changing forms of money. And I am definitely going to borrow that from you in the future, because also coins have changed in terms of the type of metal that they're made out of, the value of that underlying asset, as it were, as well. I think we're going to set aside CBDCs for the time being, as the publicly issued form of central bank money that's available to the general public in its retail form. We've done loads of podcasts about that already, and I don't want to disappear down that rabbit hole. Let's focus on the privately issued side of things. Now, private money, or the concept of money that's issued by a private entity, is not at all a new thing. And again, this goes back to your history of money point. Tell us a little bit about commercial bank money, how it's evolved, where it's going, and what the difference between that and stablecoins are, please.
Happy to. So again, I don't want to get too down in the weeds because, as you said, we're coming up on the holiday period. And I don't think anybody wants me to be reading from the FSMA definitions, but I do think that we need to start with thinking about, what a deposit is at the outset before we get into like tokenized commercial bank money. So a deposit is a sum of money that is paid on terms under which it will be repaid with or without interest or premium at a time or circumstances agreed upon by the person making the payment and the person receiving it. So it does not refer to the provision of any property other than currency or services or the giving of a security. So that means that deposits are not bearer instruments because they are not representing an underlying asset. You're not transferring an asset when you transfer a deposit. You're transferring that sum of money which needs to be repaid. So, well, you're not transferring the sum of money. You're transferring the notion of
it's
that.
like an IOU, right?
Yes.
When I take, and this is something many of our listeners probably heard me say before, but when I take my £100 in cash that I've had stashed under my mattress or something to a bank branch, should I be able to locate a physical bank branch, and I deposit it in my bank account, I no longer own £100. What I own is now a claim against that commercial bank for the sum of £100, but which is actually no longer backed even by £100 that they hold just sitting in a vault. It's probably because they've used it as basis for making loans and extending credit. It's now backed by about £10 in a vault, along with some other some loans and liabilities due to them, alongside a lot of prudential regulation, the financial services compensation scheme, and all the stuff that gives me trust in the financial system.
Exactly. So at the end of the day, those deposits, as we said, not bearer instruments. So they would also not be a bearer instrument really in tokenized form. They are a tokenized version of that deposit. Commercial bank money consists mainly of these deposit balances, which you can transfer either by means of paper orders or checks or electronically. So let's leave that to the side for a second. And now think about the fact that a bearer instrument, which you've mentioned a couple times now, entitles the holder of the document to the rights or of ownership or title of the underlying property. So a deposit cannot be the bearer instrument, as we agreed, but stablecoins can. So let's think about the difference between a stablecoin and a tokenized deposit. So, and first, I want to note we plan to discuss the UK stablecoin proposals later, so I will share their definition with you in a second. But first, I want to share my own broad conception of a stablecoin, which is a type of digital asset that's designed to minimize price fluctuations in reference to another asset or assets, and not issued by a central bank. So this, one type of stablecoin then would be an asset-linked stablecoin whose value may be fixed or variable. And I'm not going to get into algorithmic stablecoins today, but I want to focus on asset-linked ones, which could be backed by fiat currency linked to either one or a combination, like a basket of fiat currencies, other assets linked to physical commodities like gold, or digital asset linked, or a combination of these assets. Now, as you know, and have probably heard me rant about before, we don't have a global taxonomy for digital assets. So this is still very much my opinion based on discussions that I've been having with industry. And there are still debates about other types of stablecoins like algorithmic ones, and if they can truly claim to be stable, but I'm not going to dive down that rabbit hole today either. So that would be my definition. The Bank of England defines stablecoins as a form of digital assets that purport to maintain a stable value relative to fiat currency by holding assets which may be of variable value as backing. So I would note that crucially within their definition, the stablecoin must be backed by fiat currency, and they have some other requirements for systemic stablecoins as well, but happy to get into that later. So I think coming back to what you said originally, yes, some very ambitious fintechs might be looking to issue stable coins as well. They might think about catering to the broader payments and financial services industry. But given these definitions we set out, and given if you think about who's using commercial bank money today, it's banks, it's commercial banks, it's large multinational banks. I think that it's likely that the stablecoin issues that we'll see will be also those large multinational capital markets banks who could have the option to issue stablecoins at scale, make them available for use on existing payment systems, or participate in initiatives like the Regulated Liability Network, the RLN. And I think that's also why we've seen the Prudential Regulatory Authority, PRA, and the Dear CEO letter and the FCA proposals on stablecoins. And part of the reason that we're seeing this move into regulating this space.
I want to make really clear as well that not all stablecoins are used for the same purposes. I mean, some in future might be used as investment assets. So where, for example, one is, referencing and potentially backed by gold or something like that. Or most of the large stablecoins today, so Tether's USDT, Circle's USDC, are not actually used as a means of payment as such. They're typically used for settlement or for holding value on cryptocurrency exchanges. And it's not yet clear whether they're going to fully make that transition across to be used in retail payment systems. And the focus of both the FCA and the Bank of England's discussion papers so far has been not on the use of stablecoins as a means of settling or holding value on crypto exchanges, not as stablecoins being used in wholesale settlement, so on digital asset markets, for example, but rather very specifically for them being used as a means of payment in in retail payment systems, specifically at the FCA level, and systemically important retail payment systems at the Bank of England level. And the treatment that's being proposed is different to that of commercial bank money, because stablecoin issuers are not necessarily commercial banks. Commercial banks engage in the core activity of credit creation, which means they not only take deposits, but they create credits as well. So they create deposits by making loans. Stablecoin issuers are not as envisaged as doing that. What are some of the existing stablecoin kind of backing models that are out there today? And how might these be impacted by the regulatory proposals in the discussion papers?
So again, I want to take a step back, but not quite far as back this time as medieval times, because you mentioned obviously these retail proposals, which you're right, the regulatory discussion papers that have been set out are focused on retail markets. So I think first let's think about what sparked all of this, and indeed, as you'll be very aware and probably have discussed in other podcasts, also sparked a lot of CBDC exploration, which is the elephant in the room, which is Libra and Diem, because that was a catalyst, I think, for a lot of central banks to start thinking about what this would look like at scale. Because obviously, when they looked at Facebook, Meta, and the large user base that it already had, they became very worried that if a coin, were to be issued such as Libra, that it would have immediate uptake, and you would then have that systemic retail payments. And I think in the case of Libra, it was going to be dollar backed, wasn't it? That was someone, well, the proposals changed a few times.
I think, yeah, original Libra was backed by a basket of multi-currency cash instruments and cash-like high-quality liquid asset type things, but it was an interesting structure, to put it mildly, whereas subsequently Diem proposed a number of single currency stablecoins, which were backed by the individual currencies, I think.
Yes, yes. So I would say that that's kind of the first example that I would set out. And I believe that that was a catalyst for a lot of these concepts that we see within the discussion paper. You mentioned a few others, obviously, already: USDC, USDT. We've talked about Paxos before, USDP. Sorry for the podcast listeners, because this is just sounds like alphabet soup now. But all of these do have, as you mentioned, slightly different business models and purposes. And we even recently as well saw, SocGen Forge also entering into the stablecoin market. So the subsidiary of SocGen that's dedicated to crypto assets, and they registered as a digital asset service provider with the French AMF. It was just last week or the week before, and announced the listing of their euro-backed stablecoin, which will be issued on the Ethereum blockchain. It's called Eurocoin Veritable, EURCV, and it's on the crypto exchange Bitstamp, I believe. So yes, there are a lot of different models in the market. And as you mentioned, these are separate to the commercial bank money models, which resembles more what JP Morgan is doing with JPM coin, which is a deposit token. So while these are different paths to enter the digital money landscape, I do think we will see the advent of both from the new challengers, but also from the traditional banks, because there are huge efficiencies to be gained for them, and cost savings, and innovation to be had as well. But I do think, and you and I have discussed this before, is there's a question will it be a change in existing business models, or will it be similar technology used with business models that are already existing in the case of commercial bank money? So I think there's still some unanswered questions there of exactly how the market will develop.
I think that there's some super interesting topics there. There's so much we could dive more into. I think one of the things that we've very clearly seen over the past 12 to 18 months has been this world of stablecoins and the emergence of digital forms of fiat currency and things like that used to be, when it came to private issuance, very much the preserve of fintechs and crypto companies. It was not really mainstream. And as you said, there have been projects like JPM coin and things like that that have been explored in limited circumstances, how these can be used to more efficiently transfer value. But over the past 12 to 18 months, we've seen this crossover, this kind of tipping point, where now it's large financial institutions that are taking the potential of this very seriously. And they're exploring both the tokenization of deposits as well as the issuance of stable coins as two different potential, applications, two different types of money that they might make available for use by clients in terms of tokenized deposits, and potentially, more broadly by payment system operators in the context of stable coins. And on one hand, it's great because this represents a digital evolution of financial services, but it's not quite, I think, what the visionaries of the digital asset space originally had in mind when they were thinking of, how can we create genuinely innovative, economically and socially beneficial business models? How can we really radically innovate in this space? What are your thoughts on what the potential still is out there for that kind of innovation and what we might see? And this is a very open question because we haven't really talked about this before, but we're probably unlikely to see something on the scale of Facebook, what was then Facebook's, what was then Libra proposal. So what are we likely to see aside from bank issued stablecoins? What's a non-bank issuer and their business model going to look like?
So I think that maybe we should go to our regulatory discussion next, because policy and regulation is very much my focus, but I do think that it will set the tone for what we see in terms of innovation. Because if what's being proposed in regulation only allows for specific types of business models within financial services, then you won't be able to have the scaling of these other new and innovative types of business models within broader retail and wholesale financial services. So I do think it depends on how the regulatory frameworks evolve very much, because I think that otherwise, what's the incentive for you as an innovative or smaller player to develop a new business model if it won't be allowed to function in the market? Sorry, that doesn't really answer your question. I do think it very much depends on the regulation, which isn't set yet. So, we do have MiCA, which is going through its regulatory technical standard process. But in the UK, we only have retail discussion paper proposals now. So not even consultations yet, and not policy statements. This is at discussion paper phase, and we don't have the wholesale component. So I think it's very difficult to say what the market is going to do, because in some ways the market is still waiting on that regulatory certainty.
So I think what we don't want to do on this particular podcast is a deep dive into the UK proposals. We're all busy working on our respective associations' responses to those proposals at the moment, and we're likely to see, a lot more formal discussion of that over the coming months as well. But let's talk about what a good regulatory environment that provided positive incentives for innovation might look like when it comes to stablecoins. I think in order to address that, we've got to really think about what are the benefits that stablecoins can bring to the market. And more efficient transfers of value are one of them. The fact that they enable the use of the underlying distributed ledger technology to cut through a lot of the technical and structural inefficiencies in the markets and things like that, and to genuinely transfer value more easily, and also to allow for peer-to-peer, unhosted wallet payments and things like that as well. But what other potential for innovation is there, and how can a regulatory framework support that kind of innovation, especially when it's innovation we might not foresee right now? Like Sir John Cunliffe always gives the example of the iPhone, and that, when the first iPhone came out, when was it, 2006, I think, no one foresaw it becoming as ubiquitous as it is today. No one saw the App Store coming.
Right.
And similarly, when we have advances in digital technology and advances like stablecoins, it may be unforeseeable, but how, from a regulatory framework perspective, can we support that kind of innovation? And where are there good examples in your experience as a global organization?
So I think one example I would point to is, I think regulatory regimes should be careful about how much they limit backing assets. So I completely understand that in retail markets, you want to make sure that retail consumers are protected. But I think that constraining the backing assets to being, for example, only sterling or only dollars for stable coins isn't a great idea. I think that if the issuer can prove that they are mitigating risks appropriately and meeting principles-based requirements, then potentially other assets should be allowed for as well, such as gold, which we discussed earlier. The reason I say this is because I get a little bit nervous anytime that I think, of regulation having too many constraints based on what's happening in the market right now. So I think a good example of a piece of legislation that does not do this is the Electronic Trade Documents Act, which, allows for electronic trade documents. That doesn't mention any technology specifically. It does enable the use of DLT and blockchain for electronic trade documents, but it doesn't say you have to only use X, Y, and Z forms of technology. And I think that's a really good example of being future-proof in your legislation. And I think, so with regards to the backing asset, I think to limit it to just one could potentially put in too many constraints. So a good regulatory regime would allow for issuers to instead prove themselves to the regulator with sensible proposals about how they will maintain the value. I think another way that regulatory regimes can enable innovation is to think about how stablecoins will operate on a global scale. So, for example, in the UK, you have the overseas persons exemption, which is broadly used across financial services in general, not digital financial services, but financial services. And that has essentially been the basis for liberal access to UK markets. And it also allows UK market participants to access outside liquidity. Now, same thing, of course, for retail markets. Of course, you will need to have the appropriate protections, disclosures, financial promotions rules in place. But I don't think that limiting market access is a viable way forward, because if the UK or any other jurisdiction chooses to constrain access to their markets, either in or out, that could have negative consequences for financial services as a whole and for positioning yourselves as like a digital leader, a digital player. So I think that at the end of the day, it comes down to this future-proof regulation that doesn't constrain the market or new business models. Because as you said, with the iPhone, we don't always know what those new business models will be yet, but we shouldn't be afraid of new forms of money. As we talked about in the beginning, this has been happening for centuries. We simply need to work out where it fits into the broader landscape and how it can meet both appropriate and proportionate requirements for the roles it will take on.
I think that's a really interesting point around, firms needing to, it being less about having prescriptive rules around backing assets, for example, and more about firms needing to prove to a regulator that they're able to manage risk and to ensure outcomes within the parameters that are set by regulators. But that's tough from a regulator's perspective. I mean, I guess if you have a smaller firm, many small firms who are basically, following an EMI type business, so an e-money institution type business model at the moment, will want to be quite conservative in terms of their assets. Under the current e-money regime, actually, you're allowed to use a very limited number of HQLA or high quality liquid assets in addition to cash to back your e-money issuance, but most of them prefer to just go with full reserves in cash held with a commercial bank because it's easy and simple. On the other hand, you can easily see, larger, more sophisticated institutions coming along with some pretty complex proposals for how they want to set up their treasury function and how they want to back their assets and the type of assets that they should be, able to use to do this. And from a regulator's perspective, I mean, we've got proposals from the FCA more around the conduct side and for the less systemic stable coins. We've got the Bank of England looking at systemically important stable coins. At some point, if we were to open up those backing assets, arguably it might bring in some need for more prudential oversight. Do you think that the current regulatory model that's proposed is flexible enough to accommodate that, or do we need potentially greater involvement from the PRA, for example?
Well, I think that, I mean, as you said, what's currently proposed is only under discussion. So I do still think that it might change a bit. I completely agree that if you open it up, then yes, you will need to have appropriate prudential oversight to match, but that's as it gets to that systemic level. And I think that there are still more conversations to be had about the move from non-systemic to systemic, what that looks like. And I think maybe we should give a bit more consideration there to how you might transition if you were a small firm that then suddenly becomes systemic, and how the regulators could support that process. But to answer your question, yes, if we did go the opening up the backing assets to other options and more complex proposals, then yes, that might coincide with other prudential requirements, but that would need to be determined based on what the proposed model was. And I think allowing that degree of at least some flexibility according to what is being proposed, how big the company is, and what stablecoins they are proposing to issue, I think that would be a good way forward that could still allow for innovation from smaller players and from larger players as well, who, as you say, might be able to bring a degree of complexity, but also may be able to innovate very responsibly in a way that we haven't seen before, if not constrained to only one type of business model.
I want to end with just kind of circling back to the beginning, and the Prudential Regulatory Authority in particular is very keen. Well, I think all three of the regulators, the Bank of England and the FCA as well, are very keen to distinguish between the activities of banks and the activities of stablecoin issuers. And the PRA sent out a Dear CEO letter that summarized how they think, a bank that is issuing both a tokenized deposit or is a deposit-taking entity and issuing stablecoins as well to treat those. Can you give us a brief overview of why they want to make that distinction really clear, what the difference is, again, between a bank, a commercial bank, and a stablecoin issuer, and what the PRA is proposing that banks that want to issue both kind of put in place to make those distinctions clear?
Yeah, so, and I will try to make this as brief as possible, but I do think it comes back to that distinction that we made at the very beginning between stable coins and tokenized deposits. So stable coins backed by assets or some collection of assets. Tokenized deposits, they are a tokenized version of a deposit, which is essentially an IOU, a loan to be repaid in tokenized form. And if you are a deposit taker under pretty much, I think, almost every jurisdictional regulatory regime, you have to already comply with certain forms of regulation, and you have to have the appropriate legal entity structure to be a deposit taking entity and to create loans. And so that Dear CEO letter, I think the three key things it sets out were that, one, if you're already a deposit taking entity, you need to have the appropriate legal entity structure, and that your tokenized deposit structure must be separate from any stablecoin issuance structure. So you can kind of see that actually already with the SocGen Forge issuance. That's done through SocGen Forge, separate legal entity. If you're not already a deposit taker and they determine that actually what you've been doing is tokenized deposits, they want you to transition to the appropriate structure as soon as is practical, as soon as possible. And they also want you to take in the broader rules that are already applicable to deposit takers. So even if you're engaging in innovation on tokenized deposits, then you need to already be complying with these broader structures that are in place for banks as deposit takers. So, as you said, I think that's really crucial because it's just that separation of these two concepts, and that if you're a stablecoin issuer, you're not a bank. And if you are a deposit taking entity, you are a bank. And those are different things.
And they have different protections. They have different
Yes.
consumer protections attached to them, don't they?
Exactly. And that's why you have not only the FCA, but you have the FAWs, which you can go to if you have, if you have complaints, you can, the Financial Ombudsman Service. Sorry, I'm just throwing out more alphabet soups here. But yes, this is why, because you have different protections for retail consumers, for deposits. You have different protections for commercial banks with deposits. The stablecoin regimes, as we've seen, are still being developed. So I think that's really crucial to separate out those concepts, and for firms who may be listening, maybe not, to think about what kind of entity they might be or what kind of entity they might want to be in the future.
Thank you, Elise. It's been great having you here today. A bit of a dense discussion in the run-up to Christmas again, but I think it's really important that we are able to clearly distinguish between what a tokenized deposit is and what a stable coin is, and why they're different as well. So thank you so much for coming on today. And the listeners enjoy it as much as I've enjoyed recording it.
I hope so too. Thank you.